recording. So guys, we are already on chapter 11. Can you believe it? Chapter 11, and we are going to delve into a financial statement called the statement of cash flows. So we've talked about the statement of cash flows prior in other chapters, but we're really going to get into the nitty-gritty of this financial statement. Now we know that the statement of cash flows is broken into three types of activities. Operating activities are pretty much a big portion of the statement of cash flows. This would include receipts and payments for transactions related to why the company's in business, how they make revenue, and the expenses associated with making that revenue. The investing activities only include cash transactions involving the purchase and sale of long-term assets and current investments. That's it. And then financing activities are the inflows and outflows of cash resulting from external financing, taking out loans, paying back loans, and stockholders' equity, the stockholder section, not the retained earnings, but the stockholder section of financing. So here you see various activities that relate to a statement of cash flows broken into the operating or the investing or the financing. Okay. You see, this is a new format we're going to use, or a new format we're going to learn about, where we break it down into these activities. So here's with operating, inflows would include sale of goods and services, collection of interest and dividends. The outflows would be related to inventory, any operating expenses, interest we pay, and income taxes. As it relates to investing activities, inflows are the sale of investments or long-term assets and the collection of notes receivable. The outflows would include purchasing investments, long-term assets, or lending money to people for notes receivable. Then, regarding financing activities, it would include the issuance of bonds or notes payable, the issuance of stock, and then the outflows would be repaying bonds or notes payable, the acquisition of treasury stock, and the payment of dividends. Guys, this is really key that you know this. So this is a really good slide to have handy for you. I'm just going to sit on this one for a minute. Okay. Remember, sometimes students wrongly show dividends in the statement of cash flow. when we receive dividends, when the company receives dividends, they're part of operating activities. But remember, dividends we pay are part of financing activities. When we receive dividends, they're operating. When we pay dividends, they're financing. So some of the items we need to get ourselves going is we'll need the income statement, the balance sheet, and some detailed records. Now, you'll see the income statement, the revenues and expenses, along with changes in current assets and current liabilities, will all be used for the operating activities section. For the investing activities, all we need are the changes in long-term assets. For the financing activities, we'll need changes in long-term liabilities, along with the stockholders' equity section. So this helps you understand what sources we'll gather to get the information for the various sections. And anything to do with non-cash activities aren't a part of the statement of cash flows. Let me just make sure everyone looks like they see there. Okay. So let's say you purchase a truck by taking out debt. So there's no cash involved. You acquire a truck and equally the entire amount is financed through debt. Then this would be a non-cash activity. Cash was not handled. Or if you purchase a truck by issuing stock. Or if you convert bonds payable into common stock. Cash was not affected in these transactions. Exchanging long-term assets without any cash, again, is a non-cash transaction. Now, there's two methods in preparing for a statement of cash flows. One method that we've talked about previously is the direct method, and we're going to focus today on the indirect method. The indirect method is usually easier and is more common. Ultimately, both methods are going to come up with the same figures, but the indirect method begins with income, and then it lists adjustments to net income. The direct method adjusts the items in the income statement to directly show cash inflows and outflows. No, most people use the indirect method. Companies choose between the indirect and the direct method. The indirect method is easier to use, cheaper to prepare, and is used in practice with most companies. The direct method's more logical, but either way, the investing and financing sections of the cash flow statement are identical. Changes in the operating section. So we're going to look at this exercise, and we're going to look at these various analysis of an income statement, balance sheet, and additional information from the accounting records reveals the following items. Indicate in which section of the statement of cash flows each of these items would be reported. Would it be the operating activities, investing activities, financing activities, or a separate non-cash activities note? So I'm just going to give you a minute here and attempt this. And then if I can get a couple of you guys to help me on these, Maybe the first person can take the first 5, and then someone can take the next 5. But let's give yourself a minute to do this. Okay. Is anyone willing to take the first 5? You can just unmute your screen and say, I'm ready. Anyone? Well, I'm sure not going to call on you. Okay, I'll just do it then, because that's not what I want to do, is make you uncomfortable. Okay, so in regards to purchasing a patent, it's investing. Depreciation expense would be operating. An increase or decrease in accounts receivable would be operating. Issuance of a note payable is always financing. Anything to do with inventory would be operating. Collecting a note receivable, investing, and purchasing equipment's investing. Exchange of a long-term asset, remember, non-cash. Decrease or increase in accounts payable is operating, and paying dividends would be financing. Which of the following would be included in the operating activity section of a statement of cash flow? C, increase in the balance of accounts payable. Now let's talk about preparing the statement of cash flows. We start with operating activities. Then we'll do investing and then financing. So in regards to the income statement, we're going to take the income statement and we're going to start with net income. Okay, then we're going to take the balance sheet and we're going to compare 17 to 18. And if there's an increase in accounts receivable, inventory of prepaid rent, we're going to increases, we will subtract from the statement of cash flows. If there are increases, increases in accounts receivable, we will subtract from the statement of cash flows. So regarding current assets, if there's an increase, we subtract them. If there's a decrease, we add them. As far as current liabilities, if there is an increase, we add it. And if there is a decrease from one year to the next, we will subtract it. And I'll explain why in a minute. Then they provide us with some additional information we will incorporate. So we start with our net income from the income statement. From there, we will make adjustments to net income to come up with our operating activities. Then we'll do the investing and financing. We will show the cash at the beginning of the period and adjust that with where we show the net increase or decrease in cash for this period to come up with our cash at the end of the period. So we're going to show changes in current assets other than cash and our current liabilities from the balance sheet. Remember, we don't put in non-cash activities. Non-cash to provide, how about this? To provide a reconciliation from net income to net cash flows, we need to remove non-cash activities from net income. So what's left is operating cash flow. So if you understand that, think of it this way. When we show our net income includes depreciation expense. Now, you know, and I know depreciation expense doesn't involve cash, but yet it still reduced our net income. Because of that, we're going to need to add back depreciation expense in order to accurately show the true net income from cash activities. Another thing that we are going to have to add back into the operating section of the statement of cash flows are gains or losses from the sale of assets, because those gains and losses from the sale of assets affect what our net income is. Well, because we start with net income, and that's part of operating activities, we are going to add or subtract the gains or losses from selling assets, because we want to arrive at the net income from operating activities. And that would skew the actual operating activities, because the net income would include any gain or sale of assets, which would be included in the investing portion of the statement of cash flows. Then changes in current assets and current liabilities, we would look at, because increases in accounts receivable, if you think about this, is the amount of revenue that is reported in the income statement, but yet cash hasn't been collected. So that's why we need to adjust those items in order to show actual cash. Here, hardware suppliers reports net income of $165,000. Included in net income is a gain on the sale of land of $20,000. Comparison of this year's and last year's balance sheets reveal an increase in accounts receivable of $35,000, an increase in inventory of $20,000, and a decrease in accounts payable of $55,000. Prepare the operating activity section of a statement using the indirect method. I'm going to give you a minute to look at this, or attempt it, and then we'll do it together. Okay, guys. So what we'll do is we start with net income. Let me just fix this. We start with net income of 165. Then we're going to reduce the gain on the sale of land. We're going to show an increase in accounts receivable as a minus, an increase in inventory as a minus. But so assets, you do the opposite. Current liabilities, you go in that direction. A decrease in accounts payable, you'll subtract. And then our net cash flows from operating activities stands at 35,000. We start with our net income. And in this case, we're going to subtract all of these to come up with 35,000. That's kind of fishy here. All of these adjustments are subtracted from net income and arriving at net operating cash flows. This could be a natural occurrence, or it could imply management is using some techniques to overstate their net income. Which of the following would be included as an adjustment to net income in the operating activity section of a statement of cash flows using the indirect method? A, depreciation expense. B, purchase of a truck. C, issuance of common stock, or D, payment of cash dividends. I'm hoping, yes, you said A, which is right on. So in regards to the operating section, we start with our net income and then we make adjustments to reconcile our net income to net cash flows from operating activities. We add back depreciation expense and amortization expense. We'll add the loss on sale of assets and we'll subtract the gain on sale of assets. Remember, the reason we do that is because net income includes a loss or gain on sale of assets. But we want to remove that loss or gain because we want that net income just to be related to operating activities, where the gain or the loss on the sale of asset is an investing activity. The next thing we'll do, if there's an increase in a current asset, we subtract it. If there's a decrease in the current asset, we add it. But with current liabilities, we flow with if it's an increase, we add it, a decrease, we subtract it. We do all that to come up with our net cash flows from operating activities. Now, guys, I'm going to tell you something. This is a great slide to have near you when you do homework or the quizzes. So that way you've got exactly what you need to add and subtract to derive at the operating activities. I'm going to give you a minute here to just write this down. This is huge, guys. This sheet right here tells you everything. Okay. Now, eGames reports net income of $42,000 and it shows depreciation expense of $9,000 in its income statement. Well, that $9,000 is a non-cash activity that has reduced your net income. Therefore, that is why we will add back that depreciation expense to appropriately record our net income from operating activities for cash purposes. When eGames sold land originally costing $10,000 for only $6,000, it shows a $4,000 loss. That $4,000 loss has reduced our net income. That's why we want to add it back, because that is an investing activity and we want our net income to only be related to operating activities. Students sometimes aren't sure whether to add or subtract a loss on the sale of assets. But remember, a loss looks like an expense and they both reduce net income. Treat a loss on the sale of assets like depreciation expense and add it back to net income. A gain on the sale of a long-term asset is the opposite of an expense. So we subtract it from net income to come up with net cash flows from operating activities. Then any changes in current assets and current liabilities will need to be reflected on the statement of cash flows. An increase from one year to the next in a current asset, we subtract. A decrease in a current asset, we add. An increase in a current liability, we add. And a decrease in a current liability, we subtract. So you see, eGames accounts receivable increased $7,000 during the year, from $20,000 in 2017 to $27,000 in 2018. Since it increased from one year to the next, we will subtract it in the operating activity section of the statement of cash flows. eGames inventory balance decreased by $10,000 during the year. When it decreases, we add it to the operating activity section. eGames prepaid rent increased $2,000 during the year. Think about it. If it increased, that means we used cash to increase prepaid rent. Therefore, we're going to subtract it. eGames accounts payable decreased $5,000 during the year. How does accounts payable decrease? Because you use cash. Excuse me, guys, I'm on a sneezing fit. Because we use cash to decrease accounts payable, we're going to subtract that in our operating activity section. eGames interest payable increased $1,000 during the year. We'll add that. Think about it, guys. Interest expense, usually, if we have not paid cash, it will be offset with an interest payable, which means our net income decreased because of an expense that we've not yet paid. That's why we would add it back to reflect net income accordingly to cash. eGames income tax payable decreased $2,000 during the year. Well, how does a payable decrease? Because you use cash to pay it down. That way we subtract it. Then, so we've started at our net income and made these adjustments to come up with net cash flows from operating activities. When we use the indirect method, we start with net income and we adjust this number for revenue and expense items that don't affect cash, for gains and losses that don't affect operating cash flows, and changes in current assets and current liabilities. So here is exercise 1111. Portions of the financial statements for Peach Computer are provided below. We see here net income of $130,000. Then we've got the portion of the balance sheet showing increases and decreases in various current assets and current liabilities. So we see the accounts receivable decreased by $8,000. When a current asset decreases, we add it. The inventory increased by 25,000. We know, again, with a current asset, you do the opposite. So when it increases, we're going to subtract it. Prepaid rent decreased, therefore we're going to add it. Now, guys, think about it. Prepaid rent decreased. Why did it decrease? Because we took that asset, prepaid rent, and we applied it to rent expense. Rent expense reduces net income. But if we took it from prepaid rent, it was a non-cash event. Therefore, that's why we want to add it back to our net income to arrive at operating cash flows. When an accounts payable increases, we increase it. When accounts payable, or when a payable current liability decreases, we subtract it. So here you see, we start with net income. We add back depreciation. A decrease in accounts payable, accounts receivable, we add. An increase in inventory, we subtract. A decrease in prepaid rent, we add. An increase in accounts payable, we add. And a decrease in income tax payable, we subtract to get our net cash flows from operating activities. Guys, are there any questions on this? Does this make sense? Which of the following items would be added back to net income in the operating activity section of a statement of cash flows using the indirect method? Which would be added back? A gain on sale of piece of equipment, payment of dividends, increase in the balance in accounts payable, increase in the balance in accounts receivable. Becco, you are right. An increase in the balance of accounts payable gets added back to net income, because think about it. Since we haven't paid that bill yet, accounts payable increases. But it's shown in the income statement by reducing your net income. Since we show that as an expense without having paid cash for it, that's why we add it back. Then our investing section and the financing section is going to be the same. We increase or decrease investments. We increase or decrease long-term assets, such as property, plant, equipment, and intangibles. So if eGames purchased investments for $35,000 cash, sold land originally costing 10 only for 6, and purchased 20,000 in equipment by issuing a $20,000 note payable due in 3 years, no cash being exchanged, we are going to ignore that one. But we're showing a purchase of investments. We use cash to purchase investments, that therefore it's subtracted. If we sold land for 6, we add 6. But number 3, we don't do anything with because cash was not affected. Then for financing, look at the long-term liabilities and the stockholders' equity section. So if we issued common stock for 5,000 cash, that's going to increase our cash. And when we pay a dividend, that decreases our cash. Okay, here's the balance sheet. You see that common stock went up 5,000 and we paid a dividend. They told us that information. Hey guys, which of the following would be included in the investing activities section of a statement of cash flows? The sale of a piece of equipment, payment of dividends, increase in the balance of accounts payable, or depreciation expense? Right now, I'll tell you that accounts payable and depreciation are part of operating activities. Payment of dividends is part of financing activities. So it's got to be the sale of a piece of equipment, investing. Which of the following would be included in the financing activities section of a statement of cash flows? Financing, payment of dividends. So here we have a complete statement of cash flows. The adjustments under the operating section to reconcile net income to net cash flows from operating activities. As you see, that's really the hardest section, guys, in this statement of cash flows. And then we've got our investing and our financing. We have a net increase or decrease in cash, what we would begin the year with to come up with cash at the end of the period. Now I'll let you handle the different ratios on your own. And using the direct method, which we did back in a previous chapter, we basically report the inflows and outflows directly. We show the revenue and expense items to its cash basis amount. So we show our cash inflows received from customers, from interest and from dividends, and then the outflows that are paid to suppliers for operating expenses, for interest and income taxes. So here you see, prepare the operating activity section of the statement of cash flows using the direct method. So it shows us various information here. So our net sales, and then our decrease in accounts receivable, we would add to come up with cash received from customers. Look at how we do our cost of goods sold. The cost of goods sold, if we add our increase in inventory, we come up with purchases. Then we subtract our increase in accounts payable to come up with cash paid to suppliers. Our operating expenses, we would subtract the decrease in prepaid rent to come up with our cash paid for operating expenses. And with income tax expense, we would add our decrease in income taxes payable to come up with what we paid for income taxes. So in this example, cash received from customers, $2,058,000, shown here. Cash paid to suppliers, $1,162,000, as shown in this section. Cash paid for operating expenses, as shown here. and cash paid for income taxes. Gives us our net cash flows from operating activities. Okay, so I am gonna just take a moment and go through couple questions for homework. Natalie King has completed the basic format to be used in preparing the statement of cash flows, indirect method for CPU hardware designers. All amounts are in thousands. Then it says below in random order are line items to be included in the statement of cash flows. Prepare the statement of cash flows for CPU hardware designers using the indirect method. Okay. So we know that cash received from the sale of land, no gain or loss, that will not affect our operating section. We only adjust it if there's been reported a gain or loss that affects our net income. Issuance of common stock, excuse me, so that won't affect our operating section, but it will affect our investing section. Issuance of common stock will affect our financing section. Depreciation expense, increase in accounts receivable and payables will affect our operating section. The loss on a sale of land will be used as an adjustment in the operating section because that loss affects our net income. And we will add that loss back to derive at net income from operations. The purchase of equipment will affect our investing section. Increase in inventory and prepaid rent will affect our operating section. Payment of dividends, financing. A repayment of a note payable is also financing. So here you see, we start with net income. We add back our depreciation. We add back the loss on the sale of land. An increase in a current asset, we subtract. If it's a decrease in a current asset, we'd add. An increase in a current liability, we add. And a decrease in a current liability, we would subtract. For investing, cash received from the sale of land, we would add. Purchasing equipment, we subtract. And then financing, issuance of common stock, we add. Paying dividends or paying back the note, we subtract. Are there any questions in how to complete this? Well, guys, I think I'm going to end the video now. I will put this on YouTube and have a good day.